Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Ladies and gentlemen, welcome to MacroEdge Radio. Today we've got a great treat. I'm going to be your co-host along with Melody Wright, my colleague at MacroEdge for Resites. And we have today a special guest, Lonnie Hendry from Trepp, who is the trusted commercial real estate data and analytics provider that helps navigate volatility in commercial real estate markets. So welcome today, Lonnie. Welcome, Melody.
Hey there.
Happy to be here.
Glad to have you. How are you both doing today?
Doing great.
Yep, doing well. Thank you.
Fantastic. Well, I wanted to get things started off. Trepp recently published a very interesting article that was looking at the difference between the net operating income expansion and the expansion of expenses in multifamily, particularly. And one of the things that I took away from that was that the rate of expansion of the cost of operating multifamily seems to have expanded almost faster than the net operating income. What can you tell us about that, Lonnie?
Yeah, I mean, we've seen inflation be a headline here for the last couple of years on the macro sense. We try to bring some perspective to the operating side of the business. And to your point, in multifamily, there's been a pretty significant inflationary pressure put on the expense side of multifamily operators. And so as we went through and looked at each respective line item expense, there were a couple that jumped off the page. I mean, insurance was the one that was really surprising. We've been at Trepp talking the last couple of years around how insurance is becoming more of a systemic problem across the industry. That's not really being discussed at a level that we think is it needs to be. We've seen insurance go from a requirement and somewhat inconsequential part of the operating budget to now being a significant cost factor, and in some cases, actually pushing some deals over the edge to where they just don't pencil anymore. So we went back in the report and we looked at line item operating expense data over a 10-year perspective. So we looked from 2015 through year end 2024. And the compounded annual growth rate for insurance, as an example, was 11.77%. So almost 12% compounded annual growth for insurance. If you look at total operating expenses over that same time period, they were up about 4.15% on a compounded basis annually, which far exceeds what we've seen long-term inflation. Now, obviously, inflation the last couple of years have been higher than that, but on the long term, the expenses were greatly outpacing what we consider to be stabilized long-term inflation.
Those numbers are staggering, Lonnie. Kind of interestingly, I was on site at a top 5 servicer for residential a couple of weeks ago, and they did a study on that. They have over 4 million loans. They looked between 2020 and 2025, and insurance had increased by 53%. Which is
Yeah, so I mean, if you look at
yeah.
if you look at our numbers just on the raw change over that 10-year period, it's about 175% increase. And in some markets, you look at Miami as an example, you look at some of the California markets or Houston and Texas, where you have increased exposure to either wildfires, hurricanes, hailstorms, tornadoes, whatever the case may be. Those markets, as a subset, have seen even higher. This is the national average, the 11.77. So I think it's an interesting dynamic in two regards. One, the insurance claim segments that are more prone to have insurance claims, they've obviously seen an even outsized increase in their premiums. But what used to be limited to just those 8 or 10 markets that had outsized risk has now expanded across the U.S. So you're seeing markets in Ohio Atlanta, Georgia. There's a handful of cities that you could look at where you would say, I don't know what the external risk factors are in these markets to see these sizable increases. And it's really remarkable. I think the insurance industry as a whole has had to grapple with the fact that if and when they've had storms come through or there's been flooding or something else, just the inflationary cost to repair or replace the existing, buildings is significantly more than what they were in some cases when the policies were issued. And so it's a challenge. And unfortunately, this is an archaic industry on the insurance side. You have a finite number of policy writers, and when somebody decides to pull out of a market, it's just supply and demand. If you had, five insurers writing policy in a particular market, and two of them decide to stop writing, now you have three. Their proportionate share of the risk goes up, and therefore their premiums go up. And so it's not an easily solved issue. You have some states, California, Texas, Florida, that have, kind of backstop state provided insurance if and when needed in emergency situations. But as we've seen with the Palisades fire in California, those programs are not enough to be a true backup. And so I think this is something that we'll continue to see becoming more and more of an issue. And I'm hopeful that we'll see some disruption. Although I don't think this is one where technology or modern tools necessarily alleviate some of the cost and the risk.
And this may be an unfair question, Lonnie, but I mean, what do you think could be disruptive in this space? Like you say, it's not technology. Would it be some sort of non-traditional hedging product? Like, any ideas on
Yeah, I
that
think
front?
I think that's where maybe technology or some of this like non-traditional component comes in is maybe through some increased, hedges. I do think obviously some of this is we're dealing with, building stock across the country that on, maybe outside of multifamily is just fairly aged.
Right.
I mean, if you look at the office sector, I mean, that's the primary issue we have with office now is just that we have way too many 1980s Class B functionally obsolete office buildings. So they're not performing their function as an office where people want to go in to the office every day. They're also creating hazards on the insurance side, like the
Sure.
design, the build quality, all of those things are problematic. So in some sense, accelerating some of the demolition or tear down of these functionally obsolete buildings, thus reducing some of the inherent risk, maybe is a viable option. I think the other thing is just, you know, better statistical models, more predictive analytics around when and where we think climate and other factors are going to impact things, and then incorporating some of that into the building code, which some cities have tried to do. It just, at this point, there hasn't been enough of a financial impetus for people to build more resilient buildings. But I think now that this is kind of baked in, we got a 10-year study that says insurance has changed 175% over that time period. It's probably worthwhile to spend a little bit more at construction and build buildings that are a little bit more resilient to some of these things so the insurance premiums can be less.
Yeah, I agree with that. It looks like Ulysses, did we lose you as a speaker? It looks like we have. That's okay. Um, wow, yeah. So I could see it in mortgage client books in California. People getting notices about insurance increases in even non-fire areas. That was very brutal. You could see it in how much the servicers had to advance out when that change came. In California, you do escrow analysis in May, and it was wild to see just how much more money year over year my clients had to advance in California for insurance. And so I like you say, this is this problem needs to be solved, but I agree that I think it has to be somewhat solved at the local level and really, thinking through, city planning, which is something I feel like is missing with, when I went out on the road or when I go out on the road, you see so many of those empty buildings, Lonnie, for instance, say like Dallas. At the same time, they're building brand new buildings, but they haven't really resolved kind of that overhang from those old abandoned buildings.
Yeah, I mean, I think you're spot on. It's a tough challenge for operators because those empty buildings probably still have mortgages on them just because they're not being utilized, and so it's not like you can just go tear them down. And obviously the investors that have capital deployed in those want to see them come back to life. And so it's, again, it's a challenge. I don't want to overstate it to the fact where I think this is, causing some systemic issue with individual buildings. I mean, we say on our podcast and in my classes that I teach, I think real estate by definition is a local and sometimes hyper local endeavor. You can have two buildings on the same street with completely different outcomes. Some people are very proactive in managing their expenses and they're on top. They have external help with insurance and other things. They're doing things when they update or modernize their buildings to try to get as much benefit as they can from a premium relief perspective. Some people are just much more defensive, like they don't do anything unless they have to. And I think there's a disproportionate number of people that fall into that category that are really, feeling the brunt of this. But the one good thing about the report that we put out was that NOI had actually grown 5.58% over that time 10-year time period on a compounded basis. So even though expenses were up greater than inflation over that hold period, NOI actually exceeded the inflationary expense growth. And so you weren't seeing, at least in multifamily, compressing margins on the whole. You were still seeing pretty strong NOI growth. And so I think there's a positive story to tell, that operators, even in the face of having higher expenses, were still able to grow revenue and NOI at a level that made those, multifamily projects worth more, all things else equal, over that time period, even in spite of the increased expenses.
I would imagine there's also opportunity there for operators to look at potential future upgrades, or especially with new construction, that could help mitigate those insurance costs. And then, given that NOI has been able to grow, maybe grow that even more than what the expenses have been growing at as well. Would you say that's a fair assessment?
Yeah, I totally agree. It's interesting. I was out in San Jose last week, and some of the locals there were saying that insurance companies are now actually sending field agents out well in advance of renewal. And they're effectively looking at the property like a building inspector would, and they're sending back lists of things that have to be replaced in order for the policy to remain in effect. So, electrical panels and other things. So, on one end of the spectrum, as an operator, like that's the last thing you want to have to deal with. On the other end, making those upgrades, make your building better, increases performance, and allows you to get a better rate. So, I think all of us that have been in the business know, like, operators don't want to spend money unless they absolutely have to, or there's a direct correlation to increased revenue or NOI. And in this case, some of these forced compliance issues may actually help them in the long run, even though there's some short-term pain in the short-term capex or whatever that they may have to spend. So I think this is something we'll continue to monitor. It's we did a piece on Office that we're going to release here shortly. We talked about it on our Market Pulse webinar this last month, and the insurance expense was the highest line item for Office, but it wasn't nearly as high as the multifamily. The multifamily exposure at almost 12% compounded was just really, really off the charts.
Well, I think that Ulysses is having some technical issues. As always with Twitter Spaces, Lonnie, this is how it goes. But in thinking that through, I remember like probably 2 years ago saying that I thought multifamily would actually end up being worse off than office. Do you think that that could potentially happen, just based on what you guys are seeing now?
Yeah, I probably would take the other side of that argument at this
Okay.
point. Like I feel like multifamily. We had Sam Tenenbaum from Cushman and Wakefield on our podcast about a month or two ago, and he made a really interesting point when talking about multifamily. He was saying it's the only needs-based property sector, and so there's some resiliency built into that. People have to have a place to live. And so, you're going to see ebbs and flows and cyclical components of multifamily, just like you will the broader marketplace. But on the whole, multifamily should outperform because people have to have a place to live. And I think what we're seeing now is kind of a repricing or a resetting of certain markets, whether it be Class A, Class B, or Class C. In some markets, the delta between Class A rent and Class B rent because of concessions unit for not that much more than Class B. So occupancy actually favors the Class A, because you're getting a much better unit for not a lot more cost. They're still struggling. They're struggling to lease up. I'm not, you know, pontificating or saying that multifamily is out of the woods or there's no distress. There definitely is. And in fact, we had the largest increase in multifamily delinquency this last month. It was the highest increase we've seen in the last 9 years. So there's definitely distress. But they have an inherent advantage at this point with Fannie and Freddie being a backstop for a large portion of the multifamily debt space. Fannie and Freddie currently, underwrite about 50% or originate about 50% of the multi loans. And if you look at the delinquency statistics and you look at any of the metrics coming out of those agency loans, they're really, really low still. I mean, multifamily agency delinquency is still sub 1%. Whereas you look at the CMBS market, it's, some multiple that's 6 to 7 times as much. And so I definitely think there's going to be distress. I don't think it'll be nearly as bad as office. I do think office has finally turned the corner at some level. If you look at origination stats, San Francisco, as an example, was third most prolific office origination market in the country over the last 2 quarters, behind New York and DC. So you're starting to see some life in the office lending space in San Francisco, and quite interestingly, the San Francisco multifamily market has seen the highest percentage rent increase on the multi side of any market in the U.S. over the last year. They're about 11% increase now.
It's like we've got Lonnie back here. We'll get him back as the speaker as well as Melody. So we've got a couple other interesting reports that we wanted to cover, not just insurance, not just some of these delinquencies, but price movements as well. Trepp tracks commercial real estate price movements using a repeat sales method, and they're showing Q2 results stalling and declining in prices. Their index is currently down 0.08%, and I'm curious to get Lonnie's thoughts on where that price index is currently and where you think things are going over the next quarter. Welcome back, Lonnie.
Yeah, sorry about that. I thought you guys were having challenges with the mic, so I just did a whole soliloquy here on maturity drag and
Oh
offices
no.
that missed their maturity date. So glad to have you guys.
Well,
Glad to be back.
yeah, we're glad to have you back. Feel free to continue to elaborate on it now that we've got the expert. We'd love to hear it.
Yeah, so we can touch on that in a second. I think in terms of just where we're at with the price indices and just the broader market context, like it definitely feels like we have a strengthening of what we're calling a tale of two markets, and you have the haves and the have-nots. I try to refrain from using the word bifurcation because it seems like that gets overused, but it does feel like you have a large subset of the market that is performing exceptionally well, and you're going to see prices really come back strong. And then you have some asset classes in some markets where you haven't seen much traction over the last couple of quarters, or last couple of years, even in some cases. And there's probably not a lot of optimism for those sectors and markets, in terms of value appreciation over the coming years. And so it's it's really interesting because I think some people want to draw like a really hard line in the sand and say we've either hit an inflection point and the market is back, or we haven't seen, anything yet. It's really going to crater. And it's interesting because the data says that both of those statements can be legitimately true at some level. And so if you look at origination as an example, we have about $80 billion worth of origination in the CMBS market year to date 2025, just over 80 billion. Same time period last year, we were at 67 billion. We ended up the year last year at about 108 billion total, which was a really great year. 100 billion plus or minus is kind of where you feel like the market's, moving at a good pace. And so we were over that by 8 billion. And we're, call it 13, 14 billion ahead of where we were at this time last year. So maybe we end up at 125 or 130 billion total issuance in 2025, which would be a really, really strong year. If you look at some of these transitional loans, the um, commercial real estate CLOs, short-term floating rate bridge debt, the last 2 years, 2024 was 8.7 billion in issuance. Excuse me, 23 was 8.7 billion in issuance. 2024 was 8.6 billion in issuance. Year to date, 2025, we're over 21 billion of issuance. So you can make a really compelling case that the lending community, the market at large, has said we're past the worst. Our books are open, we're making loans, and things are really positive. For every one of those, though, you have this challenge around the maturity wall, the maturity drag, whatever you want to call it, where we just put out a report. There's 23 billion worth of CMBS loans that are past their maturity and they haven't executed an extension or modification. They're just kind of sitting out there. And there's a pretty large number of offices. There's a pretty large number of retail properties, pretty large amount of volume at 23 billion that are just kind of unresolved. And it's interesting to see just how those two narratives play out. So I think on the whole, I'm optimistic. I do think the markets are generally in a much better place. I think there's a lot of unresolved issues within the banking space. I think you have a lot of shadow distress. We have a much more institutionalized private credit market, this disruption, than we had last time.
Hmm.
And it's much more opaque, and we're not going to see how systemic or how broad or how far reaching those challenged or problem loans are until later in the future, if ever. But I think on the whole, I'm feeling pretty optimistic about where we are, but I wouldn't suggest that we're out of the woods at this point. I think you're going to see continued price appreciation in most major markets, but at a much more tepid pace than what we saw the last 10 years before COVID and the interest rate hikes.
Interesting. I definitely want to talk about that maturity drag, but I'm curious if you guys track like what industries you're seeing that new origination in.
Yeah, so what's really interesting is of the 80 billion plus of CMBS origination, about 22% of that is office origination. It was actually the largest category for 2025 year to date. So you may see that or read that or hear me say that and say that doesn't make any sense. That's crazy.
Hmm.
It kind of is. It's factual. But it makes sense when you look a little deeper. It's predominantly very high end, highly amenitized Class A buildings in, say, New York metros. Like in Manhattan, there's been about plus or minus 14 billion worth of issuance across, call it 22 to 23 billion in the office space. And so it's really five or six, 10 buildings in Midtown that are kind of pulling that up. But if you look back the last 2 years prior to 25, there wasn't that much total issuance across the country. So it's a positive sign in that regard. You've seen a lot of industrial origination. It's still, I think people are starting to pull back a little bit on their optimism around industrial, but data
Hmm.
center lending has been extremely hot.
Hmm.
There's been a lot of originations around data centers and some of the large scale industrial and retail even. We're seeing there was a big deal in Hawaii that just got refinanced. It was like $2.3 billion deal. The Houston Galleria Mall just got refinanced in 25. So just those two assets alone, call it, we're five plus billion in origination. So very top heavy in some of the origination,
Hmm.
um, which I think maybe paints a little rosier picture than what's actually happening,
Hmm.
but still good nonetheless compared to where we came from the last couple of years.
Yeah, I guess I would be very curious because, I go to New York often. You probably do as well, and it's just wild how much the city has changed, right? And to me, I recently just walked the entire city, which is not something I'd done since I lived there, and I was just struck by the vacancy. Like it was really, in my opinion, changed. And so, you know, uh, uh, the GM building, for instance, where you could never, there were cars always piled up outside to pick you up for meetings or things like that. Not a single car. I mean, it was just a wild scene. So that's fascinating about New York. I'm just wondering. I wonder if we are seeing increased origination in some sectors because of the BBB, the Big Beautiful Bill, and anticipation of some of what people think might be stimulus, in the next 12 to 18 months. Have you seen anything like that? Or,
Yeah, I mean, I think there's a disproportionate amount of AI spending, just broadly in the macro. Like if you look, GDP came out, most recent print was at 3.3% growth, which was higher. I think consensus estimates were that it was going to be 3.1%. But if you back out the AI spending and the AI investment, you would effectively think that we were in a recession across the other industries. And so if you look at, I said San Francisco had been a pretty resurgent market from an origination perspective. You're seeing a lot of AI office leasing, which is interesting. Um, and so I think there's definitely some drivers. AI being the predominant driver. I mean, you can't get on X or LinkedIn or read any article anywhere at this point that doesn't have some mention of AI. MIT put out an interesting paper about 2 weeks ago looking at, I think it said the takeaway was about 95% of the companies that had tried to implement AI, at least to date, have not seen them be fruitful or revenue generating. And so it'll be interesting to see if that bubble continues to go the way it is, or if we start to hit pay dirt on some of these things, or if it comes crashing down. So AI is a primary driver. The data centers, I think, as I mentioned, was one of the other industries that's really strong. And quite honestly, going back just to the multifamily, we delivered about 1.4 million new multifamily units in about an 18 to 24-month period between latter part of 22 and end of 24. All things considered, if you look at the rent growth metrics and the absorption, um, while you haven't seen positive rent growth in a lot of markets, you haven't seen significant negative, where you're seeing huge rent declines. And now there's a supply constraint in the market. Cost of capital is prohibitive for new construction. Some of the tariffs and some of the immigration policies are prohibitive for construction. And so for some of those multifamily owners that are just kind of hanging on right now, if you look forward at 26, 27, 28 from a construction perspective, there's not a whole lot in the pipeline, and they actually should see pricing power and the ability to raise rents swing back in their favor here in the next 12 to 18 months, I think.
Interesting. Yeah. So, Ulysses, are you there? This has been.
I am here.
Oh,
As far as I know, everybody can hear me now.
yes, we can hear you.
Okay. Go ahead, Melody.
Oh, no, I was just gonna, I want to circle back a little bit to the multifamily because, Lonnie, one thing we're starting to see vacancy increase there, right? We know how many deliveries we've done in apartments, and I've definitely seen that argument that because we've really slowed down the pipeline of what we're building, that, multifamily is going to be okay, in 2026, 2027. But in reality, I look and see, right? And I've looked at what is being built out there, where it's being built, and there is so much oversupply. We saw positive population gains last year, but then realized that a lot of that was foreign born. And so I believe our demographics headwinds are going to be a challenge for multifamily, as because honestly, if you just take housing units divided by current population, um, the average household size is now like 2.5 people, and I think in last year that actually it had been going lower and lower, but it's not anymore as I think people are consolidating due to unaffordability. So, in my opinion, I think we've overbuilt. I think we've overbuilt for even for the next several years. And so I kind of see that we're going to have more trouble in multifamily due to those demographics. If obviously immigration has slowed, and we might even see deportation. So I don't know if you have any thoughts about that, but that would be my take.
Yeah, no, I don't disagree with that broadly. I mean, those are all things, and I think it just goes back to the position that you could support multiple narratives given the data that we see today. For all the reasons you just outlined, you could make a really compelling case that we haven't even scratched the surface in terms of multifamily distress that's here to come. And I think you could have a valid argument for your position. I mean, the migratory patterns, immigration, those things are definitely things that could negatively impact the sector. I think if you look at new construction, while the pipeline, as I just mentioned, has really dried up and you don't see things on a go forward basis, there are definitely markets across the US where, a disproportionate number of new units were delivered at a price point that no longer fits the market with in place financing that is much more favorable than what they're going to be able to refinance into in the current market. So, like, there's definitely some headwinds. But I think if I just look at the data that's available now, and I look at the Fannie Freddie backstop, like that's the part I think is just it tilts the scale in favor of an optimistic outlook, just because there's a disproportionate number of deals that have really great financing terms through Fannie and Freddie. We've seen a resurgence in the short-term bridge lending. Like I mentioned, we're up at 21 plus billion in origination volume through the end of August of 25. It appears that people are optimistic about the ability to increase rents, add value, implement a business plan, and see some positive results. It goes back to just my general thought of the local and hyper local nature of commercial real estate. I think you're going to have some markets clearly where they may be in a 5-year cycle where rents are depressed for multifamily and there's no new construction, and the new construction that was built can't lease up at anywhere close to the rents that they thought they were going to, and it's going to be a sustained and prolonged challenge. But I think on the national perspective, you look at just all of the numbers in sum total, it's pretty positive from my perspective. So I don't disagree with you that's going to be true on the negative side. I would just suggest today, in my perspective, I think it's going to be much more selective,
Mm,
very geographic centric, very property sector centric. So in some markets where migration maybe propped up median incomes and other things, so construction starts in 21 or 2020 were based off of income levels that are not sustainable for those markets. And we've seen some of that in Idaho, like Boise
mhm,
as an example, where you saw an influx. Of Salt Lake maybe is the one that kind of bucked the trend. I thought Salt Lake was going to be like some of these others where you saw a lot of people move there during the pandemic. Wealthier folks, incomes were up, and at some level they would move out, and the market would come back down. And I think it's actually kind of hit critical mass and is going to stay. But several markets in the Carolinas, in Idaho,
mhm.
in Alabama, where, to your point, I think you're going to see some prolonged distress in some of those markets.
Right, right. Ulysses?
Yeah, I mean, expanding on both of those themes, are there certain markets, maybe like Salt Lake, that you see where even if the demographic influx doesn't, go back to what we've seen over the last couple of years, maybe it slows, but there may be opportunity for people in multifamily, and it's a sort of a different subset. But much like a new home builder, they're looking at things not so much as competition with existing housing, but replacement of the existing housing stock. Um, do you see that there's maybe some markets where there's opportunity for that multifamily sector where new builds aren't as affected as much by any demographic pressures, but maybe instead of new builds, maybe the older apartment stock is affected?
Yeah, I mean, I think the population trends are interesting because in most cases you have someone moving from one market, which is a net negative for them, but moving to another market, which is a net positive for them. And if you look at Texas or Florida or some of these markets that have had sustained strong growth, like nothing has really slowed down in that regard. I mean, we just saw an announcement here in Dallas. Governor Abbott put some stuff out today about Scotiabank moving one of their regional headquarters down to the Dallas market, and we have the Y'all Street with the financial market coming here to the Dallas market. And in that instance, like there's construction cranes everywhere. I mean, we're building brand new office buildings, we're building apartments, and they're not seeing a major pullback because the demographic shift and the migration patterns in Texas have been well supported and continue to support the continued growth. In some other markets, though, I mean, it's just a challenge. I mean, they've had too much net out migration, and they're going to be challenged for that. And this is the part where I think people just they underappreciate the role of a developer in the cycle. I mean, most apartment buildings, most office buildings, most new construction, effectively shovel in the ground to turnkey CO starting to lease up. You're talking, 36 months, 48 months in some jurisdictions that are more administratively burdensome. The world changes a lot in that time period. And unfortunately, for a lot of these multifamily developers, the market's just shifted faster than what they could build, and they're going to deal with the consequence of that. You got to look at some of the build to rent stuff that's new too. I mean, that was kind of a novel concept coming out of um, the GFC, where you had Invitation Homes and a few others that were basically trying to aggregate single family residential properties at scale and turn them into some sort of horizontal multifamily development, but they were too bespoke and they were not attached at all. And during this latest disruption, you've seen developers get a lot smarter with that, where they're building set aside subdivisions of new construction single family that effectively replicates the lifestyle of an apartment, but you get a garage, a backyard, and a bunch of other features you don't get with a typical apartment. So that definitely puts some pressure on the multifamily side. Some of the data that we've seen shows that people are willing to pay more for a single family detached rental than they are an apartment, and they actually stay longer in those units than they do an apartment complex. So I think it's somewhat like what Airbnb tried to do as a disruptor in the lodging sector with varying degrees of success. Some of these build to rent neighborhoods are having the same type of impact on traditional multifamily. And I do think that's something we'll see continue into the future.
Yeah, and you can see them sort of all over the country, and but been a lot of horse trading with some of those subdivisions, Lonnie, where the builders have sold them, to somebody like American Homes for Rent, and in bulk, and so it's a very interesting market. One thing I'll say about them, though, is the quality that I've seen out there is not great, for a lot of these big subdivisions, and you can go to a brand new subdivision that's only been sort of active for 6 months, and already it looks like it's been active for 5 years. And so I wonder about that. But so I think, to your point, absolutely, you're absolutely right. They got smarter about it, but then some of them thought they could just, put up really crappy homes, and get that rent. And I think those folks are going to suffer.
Oh, I fully agree with you. I've seen it firsthand where you have, they're basically taking a track home and they're making it even less quality than what they would typically build. And to your point, it'll be very interesting to see how that evolves over time, because as soon as the neighborhood gets run down to a certain level, it's a self-fulfilling prophecy where they have to drop rents or their occupancy is going to drop. And so it's not like a typical apartment complex where you have maybe 15 or 20 buildings and then you have multiple units per building. So if someone doesn't take care of their individual unit, it doesn't really become a stigma issue for the complex. Whereas here, if you have 250 homes in a neighborhood, and 15 or 20% of the renters don't take care of them, it becomes a real eyesore very quickly. And I think I don't think the risk is symmetrical. There's definitely an asymmetrical risk on some of these build to rent, and I'm still not convinced that you can effectively manage them on a cost basis at a level that's required to make them as profitable as they need to be to compete with traditional multi. I mean, one of the benefits of traditional multi is just the scale factor that you get because of density. You're not getting that same efficiency or economy of scale with the single family that is out on the expense side too. So I'm not sold on the build to rent. I think it's going to be a growing part of the market because there definitely is a lot of money going into that space. But I'm with you, Melody. I think it's they're going to have to improve the product, and I think there's still some growing pains they're going to have to go through as well.
I appreciated hearing that. I tend to share the same outlook on um, the return value, as far as having a single family development. Just the rate of return on that versus apartment buildings, I don't think they're in the same class yet. One interesting thing that I've noticed in doing research on the home building space for MacroEdge is that as of this last quarter, after all the publicly traded builders have reported earnings, the only one to have increased earnings was actually American Homes for Rent. All the other builders have had a pretty rough spring. So I wonder if there isn't maybe some beginning to even out in that build to rent and traditional apartment rentals. But I thought that was worth commenting on because you brought that up, and it's sort of a fascinating dynamic between the two.
Yeah, it's interesting too in the sense that most of these neighborhoods because of the cost of the land, they have to be somewhat suburban or rural almost. That they're not being built in the urban cores for obvious reasons. And I mean, there's just not enough space,
Correct.
and the cost of land is prohibitive. And so it kind of goes to Melody's point earlier. Some of these markets that have had demographic or population trends change. At some level, I'm not convinced that people want to drive an extra 30 minutes to their job or to shopping or to whatever just to have a backyard and an attached garage. And so I think
Sure.
just that has to kind of play itself out. I mean, is if you own your home, maybe you're willing to make those suburban lifestyle changes. If you're just renting, though, I don't know that there's such a strong appeal for people to make those sacrifices.
Yeah, it's a different mindset at that point.
Correct.
Just like I don't think they'll be buying those new homes out there either, Lonnie.
Well, yeah, that's an entirely. I mean, we could do a whole
Right.
session on this. I mean, like, it's the proliferation of like 1 acre ranchette style homes across the U.S. has where you're 45 minutes from the nearest grocery store has
Hmm.
gone off the charts, and
Hmm.
at some level, that just I don't think that's sustainable, and it creates an issue with utilities and power and water and all this other stuff too. I mean, it's an interesting dynamic. I will say I think a lot of these things are driven by the lack of just affordable quality housing for people in the cities and places they want to live in. And we've put out some stuff on rent control and some of these rent stabilization programs, and almost without fail, those measures fail at providing what they intend to provide. And so, like, if you want to talk about something that I think is like a ticking time bomb, it's the debt on these rent stabilized, rent controlled apartments in the New York metro.
Mm.
I mean, those
Yes.
are you want to look up the definition of toxic asset. Like, there's just a picture of New York rent stabilized multifamily, because you cannot. It's impossible to operate them at a profit.
Right.
They're effectively a depreciating asset with no upside, and the lender would never make a loan on those properties today, knowing what they know now. And so
Right.
there's a pretty large sampling of those that over the next 5 years or so are going to come to market. And it'll be really interesting just to see how that plays itself out, because I don't know in some of those cases, given the insurance increases that we've seen, given the property tax increases we've seen, and just the overall cost of maintaining, and as someone moves out, having to bring them up to current code, I don't know if you got them for free that you could make a viable use for those in a for-profit type of way. Like, it's a very interesting thing that it started in New York. You've seen it in St. Paul. There's a bunch of stuff in Oregon, where you're starting to see these rent control measures put into place. And I'll tell you, I think the capital, the developers, they're gonna not invest in those markets. They're gonna go
Right.
to markets where they can actually let the free market play itself out, even with the challenges we've documented about the multifamily space broadly today.
Yeah. Do you have? I've heard so many different numbers of how many apartments are being kept off market in New York because of these issues. Do you know a number? I've heard like 50,000. I've heard it's quite a bit. That people are holding off precisely because they can't do those repairs, and they're just choosing to hold them vacant versus rent them out.
Yeah, so we had Jay Martin at one of our live events in New York about 2 years ago, and he was saying 30 to 40,000 units at that point were off market. And so I would expect those numbers are larger now, but it's a significant number of units, and it's going to continue to grow, because there is no way to make a financial use case. It doesn't pencil to renovate any of those units, because the money it costs to get them to current code, you will never recoup in one person's lifetime in terms of the rent. And so that's an ongoing problem, and I think logical people can agree that in certain markets, the cost of housing is too much, and there needs to be something that can help kind of, provide some workforce type housing. But the programs that have been implemented thus far have been a pretty significant failure in my mind. And it's interesting. If you look at Austin, Texas as an example, Texas is known for, being pro business, pro economy, pro growth, pretty much like you want it, you can build it. And in Texas, you build it bigger than you build it anywhere else. Austin kind of bucked the trend. Like they have a very progressive, no growth city council. They did not want to see proliferation of commercial development. Even in spite of that, just because of the overwhelming amount of people moving to the market, they built more apartments than almost any market in the US over the last 5 years. And so what's happened organically because of supply and demand is you've seen rents pull back 25% for multifamily leasing costs, which is exactly what people needed to be able to afford to live in a market where they can earn a high wage and have a good quality of life. And so there are examples. Nashville's another one where you've seen significant supply influx. Tough for the operators because concessions are high, vacancies increasing, cost of capital is more. Like there's no relief for the owner of the property when the market softens. But for the renters, those are two dynamic cities where people want to be, where the dynamics have shifted in their favor, and it's not because of legislation or statute or regulation. It's because they just let supply and demand work its way through the system. So it'll be interesting to see how. I think that's like we talked about insurance being something that I don't think it's enough discussion. I think the rent control narrative only gets one side of the equation, and it's the terrible greedy landlords. They need to be punished for building new housing. Gets a lot of discussion. At some level, we have enough case studies now across the U.S. where you can actually say, look, if you just build more housing, the supply increases and the demand becomes less than, and you see pricing come down. And at some level, that has to kind of catch hold, and where we can see some of these high barrier to entry markets in California, New York, and other places shift to a more pro-growth narrative. It has to happen if they want to retain their people.
Yes, Ulysses, are you sorry?
Yeah, it's
Okay.
okay. No, I was wondering if we could maybe touch base on another topic before. I know you've got to run soon. We greatly appreciate your time here at MacroEdge. I'm curious to get your thoughts on the current pricing of hospitality. I noticed that your pricing indicator has shown that pricing is softening, and I'm wondering, is that something that's impacting the economy, or is the economy impacting hospitality, and what your thoughts are
Yeah, so
on that sector?
yeah, this is a great question. I've been saying on our podcast now for probably the last 9, 12 months that I think if I were looking for a property sector to have outsized risk today, it's the hospitality and lodging sector. They have uh, ridden a roller coaster over the last 5+ years with COVID. Imagine in 2020, pre-COVID, nationally, occupancy for the lodging sector was around 67%, which is a strong market. If you're 65+% in hotels, you're feeling pretty good about yourself. In some markets, they were well over 70% in 2020, first couple of months. So they were feeling really good. COVID hits and your occupancy goes to single digits, if any, for the next several months. And so what happened is a lot of these hotels that were about to implement their 5-year, 3-year, 8-year, whatever cycle they're on, PIP plan or improvement plan, effectively used all of their reserves just to keep the mortgage current during COVID because they didn't have any occupancy. So you have hotels at that point that were maybe 5 years into a period of needing to be renovated that did not do the renovations because those monies were spent to keep the mortgage current. Then fast forward a few years when the vaccines come out, people start traveling. We coined this term revenge travel. Business travel came back with a vengeance. You started seeing occupancies peak even higher than they were pre-COVID. RevPAR and ADR shot through the roof. And so none of these operators at that point wanted to take any units offline and do their PIP plan or renovate the property. And so in some instances, you're 10 years into a renovation plan with no renovations, and your RevPAR and ADR are still incredibly strong even today. Like we're starting to see a gradual pullback. Doge kind of was an outsized impact when they thought the government was going to pull back and close a bunch of offices, and you thought business travel maybe was going to subside. It's materialized, but nothing like we thought it would. But you're starting to see some softening. But if you look at the financials, they're still on a relative basis really, really strong. And so what I've been saying for a while now is if underwriters look at new origination or refinance origination on hotels and they just underwrite the financials, they're probably going to continue to make loans in that space. If they actually underwrite the asset, if they go on site and they walk the property, you have a large subset of limited service hotels that do not meet their brand requirements or their flag requirements, because they haven't renovated and updated, and the hotels are incredibly tired. It'll be an interesting kind of tug of war to see who wins out in that process. I suspect people will just continue to underwrite the financials and they won't worry about the asset. But I spend too much of my life in a hotel, and I can tell you, um, hotel quality has diminished significantly. And you're paying in some cases. I mean, when I was in New York in 2019, 2020, you could get a really tired, worn out hotel in New York for 200 a night. That same hotel 600 a night now, and it's worse than it was then. So I think there's some severe headwinds for the lodging space if and when people actually start to look at the physical asset.
Yeah, Lonnie, I have to second that. I spend a lot of time in hotels as well, and just the degradation in quality is just unbelievable, and it's been kind of wild. I now ask when I check into whatever Marriott I'm checking in, which floor is the ice machine working on, or which, and they know exactly what I mean because there's usually only one working one. It's really funny, but
Yeah,
not.
I mean, elevator's not working, ice machine's not
Oh yeah,
working. I mean,
yeah,
I mean, in Courtyard in particular, I used to stay I mean, I'm a Marriott guy, I travel a lot,
yeah,
I like the rewards there, but I used to stay at Courtyards. It was like it's a solid B. You know what you're gonna get. You're never gonna
exactly.
be overjoyed, but it's gonna be clean and nice.
Yes.
And I, at this point, like pretty much will not stay at a Courtyard because they have become the worst. I mean,
Hmm.
you're seeing exterior trim on the hotel falling off. The lobbies are dirty. It's really it's just this interesting. But if you look at their earnings and you look at their reported occupancies and their performance, they're still strong.
Hmm.
And it's a little disheartening that you're paying, sometimes 2 or 3 times as much for about 20% of the quality. And I think anytime that starts to play itself out, it creates opportunity for outsized distress. And so I think
Yeah.
it may be a little slow to materialize, but I think if we circle back up here in 24 months or so, there's going to be a
Hmm.
completely different narrative around the lodging sector than what we've seen over the last couple of years on the negative side.
I would have to agree with you. I know we don't have a lot of time. I do want to talk about the maturity drag. Recently Jack Farley did a show with Bill Moreland, who is one of my favorite geeks. He comes, from the credit risk side, and really, he talked a lot about these changes in rules of the troubled debt restructuring, reporting requirements. And he kind of did a deep dive on how we now really don't have a true view of distress because of these change. And I remember the institution of TDR reporting. So looking at kind of what you guys put together on these unresolved, assets that they were set to pay off, but they haven't. What are your thoughts on some of this hidden, like you called it, I think earlier in the show, kind of the shadow market or inventory? Yeah.
Yeah, I mean, I would kind of refer to it as shadow distress because it's there. It's just hard to quantify. And I think with the changing in the reporting structure for these lenders now, it just makes it more opaque. It doesn't diminish the reality of the distress. It doesn't change the outcome necessarily, but it just gives us a lot less visibility into what's happening real time. And Bill, I've listened to a lot of his stuff. Super sharp guy. He's an insider. He's in the weeds. I mean, that guy gets down into the nitty gritty. And you could, just like I said earlier, there's no shortage of ways you could make a really compelling case that we haven't even scratched the surface on the bank distress because the extensions and modifications and recasting of loans, like all of those things have been done at scale. That's just kind of obfuscated, at some level the distress. I think all that's valid. I guess the question is just, for me at some level, this is just my personal opinion here, so take it for what it's worth. But I think coming out of the great financial crisis, the broader macro players realized, those in power realized, they could not allow the banking system or the lending markets to dry up and not provide liquidity to the marketplace. And I think whether it's ever been spoken or it ever will be spoken or whatever, there was a conscious decision made coming out of that to say they're never going to allow that to happen again. And in every instance, when you've seen a bank failure or you've seen multiple bank failures a couple years ago, they set up a credit facility or a backstop, or they set up something almost immediately every time just to keep the market moving. And the guidance from the regulator has been, if you have borrowers willing to work with you, they want you as a lender to work with them. And in our last podcast, I think it was last week or maybe the week before, myself and Stephen Bushbaum kind of got into this, and he made a really good point. He said, if you dig a little bit deeper behind the extend and pretend, it effectively requires both the debt and the equity players to come to the table. And whether it's, you want to call it split losses or give up some rights or do whatever to try to get to the best outcome. So I think extend and pretend on its face has a very negative connotation, and it feels like we're cheating the system. And at some level it is. I mean, like you didn't meet the terms of your loan, you're extending it. We don't know what the value is. Like, that should not happen by the letter of the law. But in practice, it generally has led to the best result or the best outcome for the broader market and for the individuals involved. And so, as I see the numbers, we put out our report, 23 billion worth of loans that are past the maturity date. I mean, that's not an inconsequential number, but it's not enough to bring the entire market down either. And so I think we're going to see an evolution of these things playing themselves out. When I did my little soliloquy to myself earlier, I was just saying that um, there's been the private debt markets are much more institutional in nature today than they were during the GFC. So you have a much more sophisticated private credit market that has come in and really propped up a lot of properties today with rescue capital or some other type of short-term financing or something else to keep them from going into foreclosure. It appears to be working. It's one of those things none of us know definitively if this is going to work. And if it doesn't, the crisis could be some multiple of what we saw in the past. I just don't think, those in power, the government, the regulatory agencies, the lenders themselves are just going to allow that to happen. Of extend and pretend and modification terms, being used prolifically throughout the space.
All right. Ulysses, do we still have you? Look, I think it's time for us to wrap up.
Um,
Go ahead.
I think so, yeah. Lonnie, before we go, please let our audience know where to find more of your work and what you're working on. And thank you so very much for the conversation today. It's always a pleasure.
Well, yeah, I'll come back anytime you guys like. I really enjoy talking with both of you, and I think, we're constantly tracking the market at Trepp. I mean, that's what we do. We're written into the reporting structure. We are a recipient directly of underlying loan performance data. We put out research content commentary daily. So if you haven't checked us out, you can just go to our website, trepp.com, sign up for our free research and newsletters. We have a weekly podcast where this week will actually be our 350th episode. We haven't missed a week since March of 2020. We're over 2 million listens. We were just rated the #2 CRE podcast on the CREI podcast list that just came out. And so if you haven't listened to our podcast, please check that out. And then we do a monthly market pulse webinar. You don't have to be a client. You can sign up. We've done about 34 of those in a row. I think we've had 20,000 registrants for that. And so love to have you guys check us out there. And I can be found on LinkedIn or X, and would love to connect with anybody that's interested. So very thankful to have the opportunity to talk with you guys today.
Thank you so much, Lonnie. It's been fabulous. Thank you.
All right. Well,
Yeah,
you guys have a
thank you,
great
Jen.
afternoon.
All right.
Thank you too. Thanks, Melody. And for everybody out there, remember to check out MacroEdge.net. We got a lot of new exciting things happening in the works. And thanks again for listening. Have a wonderful rest of the day.
Thank you.
Bye-bye.